With us now, we do a financial planning. For that, we have our CFP, Harrison Johnson, join us. And again, I announced this before we went to break. What is the goal of tax planning? Well, people are going to say, want to save taxes. But there's more to it than that, isn't there?
There's a lot more to it. And this is why I'm talking about it, because the obvious answer to that question is, well, to reduce taxes or maybe even reduce lifetime taxes. But that shouldn't be the focus. But people think it is. And by focusing purely on taxes, in many cases, they make the wrong decisions, accomplishing the wrong goal. So what I mean by that is the goal of tax planning should not be necessarily to reduce your tax bill. The goal of tax planning is to make decisions that will increase your after-tax access to money. So sometimes that means paying some taxes, depending on the situation, if that allows you to have more access to money or access to cash flow. So an example of that is, you want to pay less taxes, earn less money. Well, that means I have less money. Yeah, right. Exactly. So sometimes it's better to have a little bit of income or to have assets. Now, the consequence of that is maybe there's some taxes, but that also means you net out more. So this could be an example of how you invest money. Do you want to put money into a savings account that earns nothing? Well, you pay no taxes, but you also make more money. You could also stop working. If you quit your job, you're going to make less money and you're going to pay less taxes. So the goal isn't, to reduce your tax bill, period. The goal is to do things that will increase how much money you have or how much access you have to assets and cash flow.
And one thing I look at tax planning, and again, I'm not trying to knock CPAs, but it's so short-sighted. They're just looking at that year as opposed to, well, how's this going to affect me 3, 5, 10 years down the road? This is where I think a good CFP, that's a fee-based financial planner, is better because they don't just look at how we can save taxes this year, but how we can increase your investments, how we can increase your cash flow, and do the best we can on taxes.
Especially since a strategy a lot of CPAs have, or tax professionals might have, is, well, I want to defer income because I want to defer that tax liability. Well, that only helps you if you're deferring that income to a point where you can access it at a lower tax rate in the future. So 401ks are an example of that. You put income into a 401k, so you get a deferral now, but ultimately you're going to have to withdraw that later. That is a good thing if you're in a high tax bracket, you're deferring income in a high tax bracket, you access that at a lower tax bracket later. Because at a 401k, it's all deferred income. It's going to be a tax, it's just a matter of time. So really, we want to make decisions that's going to increase the cash flow, and sometimes that means accelerating income. Sometimes having income now through a Roth conversion or a withdrawal might make sense if you're in a lower tax bracket now, and then by doing so, you can avoid being pushed into a higher bracket later.
And I think it's just so interesting. I mean, nobody is stoked to pay taxes, right? Like, I don't look forward to tax time and looking at how much I paid in taxes last year. That's not something that excites me, but it's the reality.
Doesn't excite anybody.
Yeah, I mean, you're going to pay taxes in the long term. And I think it's just so fortunate because, as you said, Harrison, people, they fixate on that tax bill. And I think so many people, and this is maybe a silly comment, but it is true. Actually look at it and look yourself in the mirror. Some people would rather make a 5% return and not pay taxes than make an 8% after-tax return. Because, now I paid all this in taxes. Great, but you made more money in the long term, and your after-tax benefit was still even greater, even though you paid more taxes.
And that's really what it comes down to. So taking out the emotional side of, gosh, I hate paying taxes, because I do as well. Never met anybody who enjoys paying taxes, whether it's income taxes, property taxes, sales taxes, whatever it is. Taxes are something that we all hate. But again, if we focus on that as a goal, in many cases, it leads us down the wrong path. That's going to also leave us with less money. So tax planning, again, is about understanding, well, what decisions can I make? What types of assets should I be investing in? Because all types of assets create income in different ways. Real estate is different than stocks, different than bonds, different than businesses. Those are all treated differently. The types of accounts that you use, pre-tax, Roth, taxable, educational types of accounts. The account type influences what your tax liability is going to be. The way that you ultimately access that money is different. Whether you are accessing money by selling an asset, whether you are holding an asset that's producing cash flow, whether you are borrowing against an asset, all of those are ways that you're accessing money, but they're taxed in different ways. So the choice of asset, the choice of account, and then the way to access that is really what tax planning is about. And by understanding that as the goal, you'll end up with more after-tax money, which that's what everybody wants.
Yeah, it's kind of like it's just not the taxes. You talk about the cash flow. You talk about the growth in investment. Doing silly things like holding investment because you don't want to pay the taxes on it. Well, you could have that investment drop 50%, take 10 years to recover it. Having Microsoft back in, 2003 for 15 years, you didn't make any money in the stock. But people didn't sell, so they didn't pay taxes, but they lost so much. The opportunity cost is what they lost of other investments.
Yeah, exactly. So nobody likes taxes, but sometimes that's the right thing to do. Not always. Obviously we don't want to go and pay taxes for the fun of it. But
It is not fun.
It's not fun. It's never fun, but it helps you make the right decision if you know you're doing it deliberately for the right reasons. Yes, I'm paying this tax, but I'm willingly do it, and the result of that is now I have more after-tax cash flow or more after-tax money because of it. That can help you stay away from the emotions and take away the bite of, gosh, I'm paying a lot of taxes.
And that's why I think a fee-based planner is much better than a CPA that's just going to focus on the taxes. You got to look at many different factors.
Well, I mean, it's a good combination, right? Like,
oh yeah, you can't get away from the
CFP is
CPA.
not going to file the taxes.
No.
Or a CFP, I'm sorry.
They should work together. That's what they
Exactly.
should do.
Yeah.
Yeah. But ultimately, I mean, in many cases, the tax side and the investing side are at odds with each other. You want your investments to grow, but sometimes that means you pay taxes. You don't want to pay taxes, but that might prevent you from investing in the right way. So you have to walk the line and understand the balance of, yes, we want our money to grow. Yes, we might have to pay some taxes, but we want to make those two decisions in tandem with each other that's going to net us out the largest benefit.
Got to have all the information, not just part of it.
Right.
Yep. Well, Harrison, thanks very much. We appreciate it, and have a good day, and we'll see you on Monday.
Thanks, guys.
All right. Again, that's Harrison Johnson. He is our financial planner. He is CFP at Wilsey Asset Management. He's a fee-based planner. He doesn't try to sell you any product, annuities, or anything else of that nature. He will sit down with you. If you want to do true tax planning, and give him a call. That's what he does. He looks at the whole picture, not just the tax side. Give him a call at the office, 858-224-0004. Again, that's 858-224-0004, or go to the website smartinvesting2000.com.